Ticker symbol BSX is up over 60% in the past year, and today we'll be looking at an industry leader with favorable growth prospects, which has consistent, predictable growth, as last year alone, its operating income grew by 35%, and although it currently has low profitability, it has had consistent net margin expansion. So today, we'll be looking at Boston Scientific, a medical devices company. In their annual report, they state that they're a global developer, manufacturer, and marketer of medical devices that are used in a broad range of interventional medical specialties. So basically, they mainly use products used in surgeries. And again, since this is a very big trend worldwide, they are focusing on the practice of less invasive medicine by providing alternatives to medical procedures that are typically traumatic to the body. So basically, they're trying to gather all the surgeries that are very, very painful and hard to recover from, and they're trying to do this as easy and with as little trauma to the body as possible, in order to, first of all, improve the success rate of these surgeries, but second of all as well to make the recovery from these surgeries a lot lighter on the body. So their main product offerings are related to endoscopy, urology, and cardiovascular procedures, which are usually those which are most traumatic to the body, and other peripheral interventions. So the great thing about this company is that it is highly innovative. So since 2023, they have received FDA clearances for over 15 products, and they're also seeking to diversify and widen their product portfolio through acquisitions. For example, in 2023, they conducted a very big acquisition for a company called Axonic for $3.7 billion, and this, of course, is very in line with their main offerings, as it manufactures medical devices that are used for less invasive procedures. Now, I'm not an expert in the medical industry, so I prefer to break down companies into numbers which are easier to analyze. So for example, over here, we can see that they have a return on capital employed of 8%, which honestly is quite low. We usually have a threshold of 15% for companies that we want to invest in, but this has been increasing in the past quarters, as we will see later on. Then they have an interest coverage ratio of 9 times, where we usually like this ratio to be sitting at above 10 times. However, since they have such consistent free cash flow and net income, this doesn't worry me too much. And they have a very solid cash conversion of 72%, a very solid profit margin of 69%, and an operating margin of 12%, which has been expanding recently, and it will soon cross our 15% threshold. As we can see, they have very strong top-line growth, with the revenue growing heavily since 2023, and we can also see that their net margin has been expanding, allowing their net income to grow at an even faster pace. And as we were speaking about earlier, their efficiency ratios have been very stable, but they have been rising at a fair pace all the way since 2020, with the return on invested capital currently sitting at around 13%. Now, one thing that is great about this company is their asset base, as they currently have over 2 times their liabilities only in assets, which gives them their very solid current ratio, which allows them to appear as a safer company to investors and overall creates a company with less risk. Now, this company gets a solid 6 out of 8 ticks for the fundamental analysis, as it has a very solid balance sheet, meaning that it's able to pay all of its short-term liabilities only with its current assets. Then it produces cash flows that are very consistent, and it is able to grow these cash flows in a very organic fashion. This, of course, is allowed by their revenue growth, but now the two most important things in this slide are, first of all, their pricing power and their existing moat, and I believe that Boston Scientific ticks both. Now, by pricing power, I mean that the company is able to raise prices or charge more than other competitors without the customer actually being discouraged to keep buying from their services. Now, in the case of Boston Scientific, I do believe that they meet this criteria because they produce extremely unique products for, we can call it, niche procedures, which allows hospitals to increase the success rate of their surgeries and allows all the clients to have a way better recovery and overall experience from the procedure. This in itself is a huge advantage for hospitals, which are willing to pay high prices for minimally invasive procedure medical devices. In the case of Boston Scientific, they have been around for a very long time and they have very good contacts with hospitals. In these negotiations, I believe that they rely a lot on trust. If you've been using the products of Boston Scientific for the past 15 years and you haven't had any trouble with them, you're willing to pay a lot more from this company than you're willing to pay for a newcomer in the industry. Because you trust them, you know that if anything goes wrong, they will respond, and in most cases, just nothing ever went wrong, so you trust their products. But now, I also believe that this company has a very wide existing moat, first of all because of their patents. Patents are the best type of moat a company can have because it essentially gives them the sole right of producing that type of product and have no competitors for a certain amount of time. This basically means that, of course, as long as Boston Scientific prices these devices in the correct way and doesn't harm their relationship with their customers, they are guaranteed to meet almost 100% of this market for the amount of years that the patent establishes. And even when the patent expires, these products have been around for so long and the company already has such a high market share in that specific niche that for competitors to enter the space is extremely hard. So this basically ensures you to become the market leader in whichever product you're offering. And I believe that that is the best competitive advantage you can have. Now, I didn't like the fact that this company has low liability risk. Of course, I'm being very picky, but I do want these companies to meet my criteria. They don't pay any dividends and they don't conduct any share buybacks. Now, this company, of course, trades at a very high multiple. It is in the healthcare industry, it grows at a fast pace, and it has very solid fundamentals. This is why it currently trades at a P ratio of above 60 times, which is in line with its historic trading averages. When we look at its free cash flow yield of 1.51%, this is a lot lower than the 3% long-term inflation rate. Both of these metrics suggesting that the company may be overvalued. Now, when we look at the risks and possible challenges, the first one that comes to mind is possible upcoming regulation changes. Now, the medical devices and pharmaceutical industry is heavily regulated. And of course, they can give you patents, but at the same time, they can reduce the extension of this patent and they can make your life a lot harder by, for example, reducing public expenditure on healthcare or just by making you meet a lot tougher criteria in order to keep your patents. This, now especially with the changes in the US government, this can have a big impact on Boston Scientific, but we will have to see what happens. And the second one is for the market. I only gave this a 50% because although I believe that hospitals will spend a lot less on medical devices in case of an economic downturn, I believe that in this industry, it is less affected by that because at the end of the day, you will need these devices to save patients' lives. So now, before we move on, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a strong competitive advantage. It produces consistent and predictable cash flows, but it does not have a high return on capital employed, meaning that currently it is not creating value for the investor. So I believe that this is a good company and it will probably be a good investment, but I cannot fully grasp its growth strategy and I don't want to invest in companies that don't meet the return on capital employed threshold. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.